Welcome to The Explainer. Today, we're diving into what's being called the anti-hype arbitrage in the carbon credit market. And look, let's just forget the usual ESG chatter for a minute. We are going to focus on the raw financial mechanics, a strategy that institutional desks are using that really hinges on one single incredibly powerful force: government policy. This sentence right here, this is the key to understanding the entire trade. I mean, think about it. For every other commodity, oil, gold, corn, you name it, supply is all about finding more or growing more. But with carbon, it's the complete opposite. The supply isn't discovered, it's deleted. And it's deleted systematically, intentionally, and by law. That makes it a fundamentally different beast than any other asset out there. So let's really dig into this idea of a deleted commodity. You have to get your head around this concept, because it shows how this whole market is built not on normal market forces, but almost entirely on pure policy. Okay, so here's how it actually works. A government, say in the EU, sets a cap on total emissions. Then it issues a fixed number of permits, or credits. But here's the crucial part. Each year they intentionally remove permits from the system. They literally delete them. That scarcity is completely manufactured. It's not driven by geology or a bad harvest. It's driven by a legal schedule, which creates this predictable squeeze on supply over time. Now, this is super important. We need to draw a very hard, very clear line between two completely different carbon markets. This is where most of the hype and, honestly, most of the confusion comes from. If you get this wrong, you miss the entire trade we're talking about today. So on the left, you've got the voluntary market. This is the side you always hear about. Companies planting trees to hit their ESG goals, even some crypto projects. It gets all the headlines. But on the right, that's the compliance market. This is the big league, institutional-grade, legally mandated system. It's not about public relations, it's about the law. And for the thesis we're exploring today, this is the only market that really matters. All right, this brings us to the very heart of the investment thesis. See, this isn't a bet on a cool new technology or a company's quarterly earnings. It's a bet on government follow-through. It is a pure play strategy, and it's called regulatory arbitrage. So what does that actually mean? Well, put simply, you're looking to profit from the predictable path that's already been laid out by law. Here's an easy example. Think about a big pharmaceutical company. Their blockbuster drug has a patent, right? And that patent has a publicly known expiration date. A savvy investor might bet against that company right before the patent expires because they know that cheaper generics are about to flood the market. That's regulatory arbitrage. You're trading a known scheduled event. In the carbon market, governments have basically telegraphed their moves for years to come. Probably the best way to understand this is to think about a central bank, like the Fed. When the Fed sets an interest rate, it's creating a price floor for money. Carbon regulators are doing almost the exact same thing. They use policy to create a price floor and a predictable upward path for these credits. And you have to ask, why would they do that? Well, because they need the price to go up. It's the only way to force heavy industries to decarbonize and hit those legally binding targets. So what you end up with is a synthetic price floor. It isn't based on market whims or what investors are feeling that day. It's based entirely on political will. The government is basically signaling to the market, hey, we need this price to go higher to meet our goals, and we will tweak the rules of this system to make sure that it does. And this quote just gets to the absolute heart of the trade. You are not fighting the government here. You are investing right alongside it. For these regulators, a rising carbon price isn't a problem. It's a feature. It's proof that their policy is actually working, and they have a deeply vested interest in seeing it continue to work. This is exactly what we're seeing play out in Europe. Governments over there have legally bound themselves to hitting these 2030 climate targets. They've staked their political credibility on it, and a rising carbon price is the financial stick they use to make sure companies comply. So really, a bet on these credits is a bet that these governments will enforce their own laws. Okay, so the theory is pretty compelling, right? But how do you actually get in on this trade? Let's take a look at the main ways investors are getting access to this market. So there are basically two main paths. The simplest, by far, is an ETF like KRBN. You can buy it in any normal brokerage account. But, and this is a big but, you don't actually own the credits directly. The ETF owns futures contracts. Now, these contracts have expiration dates, which means the fund constantly has to sell the one that's about to expire and buy a new one for a future date. This is called rolling. And if the new contract is more expensive than the one it's selling, which is pretty common, the fund loses a tiny bit of value every single time it rolls. Over time, that roll cost can really eat into your returns.
Now, for direct exposure, the big institutions trade the futures contracts themselves on an exchange like Europe's EX. It's definitely more complex, but it's a pure play on the asset without that performance drag.
This chart does a great job of just boiling it all down. When you invest in traditional energy, say through an ETF like XLE, you're betting on classic market forces: global demand, OPEC production levels, geopolitics, that sort of thing. But when you invest in compliance carbon, you're making an almost pure bet on one thing and one thing only: the continued political will of government regulators to enforce their own policies and meet their own deadlines.
But, and you knew there was a but, this unique dependency on the government, the very thing that creates this entire opportunity, well, it also creates an equally unique and very, very significant risk. I mean, an asset where the government literally wants the price to go up, it just sounds almost too good to be true, doesn't it? And that's because there is a major, major catch. So what's the downside? The answer is two simple words: policy risk. The asset's greatest strength is also its Achilles heel. The same government policy that creates this entire market can also destroy it, basically in an instant. And this is what policy risk looks like in the real world. A shock election brings in a totally new administration with a different agenda. A country decides to pull out of a major climate agreement. If you want a stark example, look at what happened to Spain's solar industry back in the day. The government offered huge subsidies. Investors poured money in, and then, when the economy went south, the government just retroactively cut those subsidies, completely wiping out investors. The exact same principle applies here. The entire scarcity of this market depends on these rules staying right where they are. And this right here is the brutal truth of this entire trade. The fundamentals of a carbon credit aren't earnings per share or price to book value. The fundamental is the political environment. And that can change with a single election, a single vote, a single stroke of a pen. The same legislative action that created this opportunity can also make it vaporize overnight. So we want to leave you with this final question, because how you answer it is really the key to how you see this whole market. Do you look at this and see an asset whose foundation is fundamentally flawed because it depends on the whims of politicians? Or do you see a calculated bet that, having staked their international credibility and passed binding laws, governments are now so locked into this path that they have no choice but to see it through? Your answer to that question determines whether this is a completely untouchable asset or one of the most interesting trades of the next decade.